Are you tired of paying rent every month and having nothing to show for it? Home ownership provides several benefits. In addition to the satisfaction of being a homeowner, you can enjoy tax deductions, say goodbye to your landlord, and most importantly, start building equity. Owning your first home can be both exciting and a bit nerve-wracking. It seems obvious, but the first step to buying a house is making the decision to buy. Grab a piece of paper and write down all of the reasons why you want to buy a house. Determine how long you want to live in the new house. Does buying still make good financial sense? Can you afford a house that will meet your list of requirements? A good rule of thumb is your mortgage payment should not exceed 1/3 of your net monthly income. Are you planning on having children? Are you thinking of starting your own business? Talk about neighborhoods, schools, and economic factors liable to affect the value of a home. Also, remember that owning a home can be very time-consuming. The weeds never stop growing. Plus, it seems like something always needs to be fixed, repaired, or painted. So make sure you have the time and the money to put into your home, or your investment won't appreciate as much as you'd like it to. When buying a home, it is highly recommended that you be pre-approved before you start looking at homes. Being pre-approved will inform you of your maximum affordable home and save you from looking at properties outside of your price range. So, where do you even start? A good place to start is to contact a loan officer or contact your local bank and have them take an application on you. It's also good to work with someone who you trust because this is one of the biggest investments you'll ever make. Also, for comparison, you may want to check 2 or 3 different banks and lenders. It will help if you can get pre-qualified for a mortgage. A pre-qualification is a verbal statement saying that you are qualified for a specific amount. Your loan officer can write a letter in which you can give to your real estate agent. Your real estate agent can then use this letter when negotiating a deal. Here are the items that banks and lenders will look for when getting you pre-qualified. Ideally, you will need 2 years of credit history and 3 to 4 trade lines showing up on your credit report. Trade lines include items such as car loans, credit cards, student loans, plus others. It is very important to pay your bills on time and to keep your credit history clean. Your credit scores will determine your interest rates, your choice of loan programs, and if you qualify for 100% financing. Most lenders require a 2-year job history in the same line of work. If your major in college was related to your current job position, that counts towards your 2-year job history, including your bank accounts, stocks, mutual funds, and retirement account. It is a good idea to have 2 months worth of reserves. This will help in obtaining a pre-approval, plus it is always good to have money saved in case of an emergency. The purchase price and loan amount must be suitable for your income. After your loan officer calculates your debt-to-income ratios, they will give you the loan amount in which you are pre-approved for. Based on your individual situation, additional documentation or verifications may be required. Common documentation includes past 2 years W-2s, last 2 paycheck stubs, and 2 months bank statements. You probably have an idea of what part of town you want to live in based on several criteria, such as where you work, where friends or relatives live, and how much house you can afford. Search all of the resources for houses on the market that fit your criteria. Preview these houses with your realtor or mortgage banker to eliminate the duds. Then, schedule appointments to tour the houses that best fit your criteria at times convenient to you. When touring a home, you may want to discuss with your real estate agent what you like and what you dislike. You may have to amend your wish list a little bit. Things that seemed important might not be so important anymore. You need to refine your search and narrow in on what your dream home is. This house of your dreams can mean different things to different people. If you're a young married couple or single, a fixer-upper may be just what you're looking for. If you have the time and energy to put into some sweat equity, it could be perfect. And remember, you'll probably move about 2 or 3 times before you settle into the actual house of your dreams. When you do find that first house, it's time to put in an offer with your realtor or mortgage banker. The offer is normally presented with earnest money or binder. This is a cash deposit by a personal check made to a property seller to secure an offer to buy the property. It's in your best interest to put up at least 1% of the asking price, but never less than $500. The more the better, if you can afford it. The earnest money is deposited into an escrow account only after you have signed contract with the seller. If you end up not getting a signed contract with the seller, the check is returned to you. First-time home buyers often freak out about the earnest money check. It's often the largest check you've ever written. However, trust your real estate agent. They wouldn't have been recommended to you if they had messed this part up in the past. How well do you sleep at night? Well, get ready for some tossing and turning. So you found the house, you've put in the offer, and you've written a big scary check. Now what? You wait and wonder. Have I offered too little for the house? Have I offered too much? Can I actually afford the payments? It is common to receive a counteroffer when the initial purchase offer is submitted. Don't let this discourage you. Discuss the counteroffer and decide whether or not to accept it. Submit your own counteroffer or reject the counteroffer and move on. Try to avoid having any type of emotional attachment to the house at this time. Your emotions can lead to buyer's remorse. Before you start negotiating the deal, set limits on how much you're willing to offer for the place and be sure to stick to those limits. During the closing period, you will be working with your mortgage lender to close the loan. However, since you were pre-qualified before you started looking at homes, you're already that much closer to the end. Just gather the necessary property information your lender needs to close the loan. You will receive a good faith estimate of closing costs at the time the loan application is submitted to the lender. The estimate is based off of the loan officer's past experience and may not include all the closing costs. Your realtor or mortgage banker will be glad to review the good faith estimate, answering questions and highlighting missing costs and estimates that may even be low. There is always the option of negotiating the closing costs with your seller, especially if you are in a bidding war or if you've offered more than the asking price. This is a good time to get advice from your real estate agent or mortgage broker. However, it's not the time to get picky. Also remember that the actual closing of the deal may be 30 to 60 days out in order for the loan to be approved and finalized. Plus, you'll have to negotiate a closing date with the seller. Be respectful to the seller because they're probably closing on a new home loan too, and maybe they want their kids to finish out the school year. Like I said, be respectful because you'll be a seller someday too. Congratulations! It's time to move into your new house and make it a home. It's also time to find out who your true friends are. Be vague about your move-in date or you'll be surprised at how many things are going on out of town that weekend. Thanks for your attention.